Hello all, hope you are all good. Thanks for this session. So thanks for this opportunity. So as part of the share market sessions, so already we have been discussed a few concepts. Okay, so right from beginning, so what are the share market and so what is the journey with a real time example, and how should we start like share marketing, and what are the different components involved throughout the career of share marketing. So already we have been discussed. So my strategy, guys, like I want to bring some real time scenarios, not only the definitions. So definitely it would be helpful for people build up their share marketing career. Okay, so most of the people give different definitions. Okay, the definitions are really important, but actually those may not be helpful to relevant to your share market real life. Okay, so I just want to try to analyze my side, because I am also in some doing some research and learning these concepts. Okay, let's jump into the these concepts, like what exactly the session today. So today actually we are going to discuss about so two important concepts, those who are uh, capital appreciation. Second one is dividend income. Okay, so please ignore spelling mistakes. Okay, just I want to make them shortcut so that you guys can understand and we can speed up our session. Okay, so I think these two concepts, like mostly have been involved in share marketing. So already people who have been involving in share marketing for last couple of years, so they know about these two concepts very well. So I think this session would be a revision for them, and but these particular topic and real-time example for beginners. Okay, so those can easily relevant their share marketing investments, and they can think different strategies. Okay, before building their portfolio. Okay, let's jump into the concept, like what is capital appreciation here. So basically capital appreciation is nothing but it's appreciation in the capital. That means, so uh, basically it relates to the increment of stock value over the time. So that means, uh, as an investor, if you buy stocks at lower price and buy them at higher price, the difference amount is called capital appreciation here. Okay, so basically this is a core strategy for investors who want to grow their wealth over the time. Okay, so that is what capital appreciation. So I definitely, don't worry guys, I will give some real time example, but this is some core understanding of capital appreciation. Okay, but what is the dividend income strategy? So basically dividend income strategy is it is relevant to that share marketing, where you by basically it's a portion of company's profit is distributed to the stakeholders. That means for example, the companies which are profitable and stable, those companies only can give these dividend income to stakeholders, or reward to their stakeholders. So basically, this is consistently we can get passive income. Okay, without needing sell off your stocks. Okay, so see, actually the capital appreciation means like once you invested into the particular share marketing, so after certain amount of time, so your stocks value will be incremented, and you can buy those stocks. I mean, you can sell them, and you can recreate your money. That is what happened in the capital appreciation. Coming to dividend income, so you just get passive income while you are holding those stocks with you. Okay, that is what the difference between capital appreciation and dividend income. Let's see some real-time example, guys. So if I take new page now, so capital appreciation, the capital appreciation, for example, one particular person, he is a corporate employee. So he is going to buy 100 shares. Okay, each share cost 100 rupees. Okay, that means total 10,000. Okay, so he has been invested in one particular organization, so where he bought 100 shares, each share cost value 10,000. Okay, so exactly after 2 years, okay, he just holded his shares without selling them. So immediately in the growth phase, actually his stock value significantly will be incremented. So where his stock value is reached to 200. That means earlier 100 rupees, now it is reached to 200. That means total now, so how many shares he has? 20,000 into each share value 200. So that means total 20,000. So if you observe the difference here, so initially he invested with 100 rupees each share. So after 2 years, that amount is reached to, that means that stock is incremented to 200 now. So almost 100% is he's in the profit stage. So that means the difference amount is called capital appreciation. Okay, that is what happened in the capital appreciation. So he just holded his stocks until it appreciates. Okay, so that is what capital appreciation. But coming to dividend income, the dividend income also, the investor basically he invests uh, like 100 shares, same 100 rupees per share. Okay, so that means total 10,000. So he just invested 10,000 in one particular organization. So he selected one profitable and stable organization where he invested 10,000 in the share market for that particular company. So, but what happened, So after 1 year, so basically the company announced his dividend income. So the company basically what exactly announced actually, so 20 rupees per share. So that means 20 rupees per share as a dividend income. Okay, so basically the investor like he gets passive income without needing selling of his shares. Okay, so that is what happened in the dividend income. So basically this is suitable for long term growth, long term and also this is suitable for long term investors. Okay, so those can buy these stocks at a certain price, and they just get passive income while they are holding their shares. That means without needing sell their shares. So this is, don't you think this is a long-term growth, and basically senior, especially senior citizens, they basically they want to get passive income, right, while they are holding their shares without selling them. Okay, so basically where they can select these particular shares, and so one more thing. So basically, so importance of these concepts, stock investors basically. So what exactly the capital appreciation? So basically essential for growing your wealth. The more stock prices over the time, so the more your investment also grows. That means when you start selecting capital appreciation, so the more stock value grows, so the more investment also grows, right? So obviously your stock value incremented, so you will think of investment more. Okay, that is what happened in capital appreciation. Dividend income basically it provides a steady stream of income. Okay, so basically where without needing selling of your stocks, particularly it's important for long-term investors, guys. Okay, so simple real-time example we will see. So basically Amit, Amit, how exactly he builds his portfolio? He just have 1 lakh amount in his hand. So out of 1 lakh amount, so basically uh, he just invested 60,000. That means 60,000 in a tech growing company, and 40,000 in one particular profitable and stable performance company. Okay, as it so he expects dividend income here, and he expects capital appreciation here. Okay, so that means after 2 years what happened, so his stock value will be doubled. That means obviously so his stock value significantly will be incremented. So obviously his investments also grows. That means his wealth also grows. And also this 40,000 he invested in profitable and stable organization. So where he gets passive income as a long-term growth, long-term investment. Okay, because here actually he gets passive income. Okay, without needing selling of his stocks. Okay, so this is what the difference between like capital appreciation and dividend income, and this is a very simple example so that you guys can build your portfolio very well. I think this is very much helpful for your share marketing life cycle. So before building your portfolio, so you have to spread your risk across different strategies, guys. Okay, don't stick with one particular section or one particular strategy. So your strategy, it could be your strategy or it could be your risk. It should be distributed across the different sectors and across different goals also. Okay, so that like in the one sector it if it down, then another sector it up. Okay, so like that you can balance your share market. So I think this real-time example really will help you and will change your mindset. Okay. So I think thanks for this opportunity. So please subscribe this channel, and uh, like I will come up with a very very good real-time example. So until then, bye bye. Good night.